And finally, I'll show you the silver chart where we have no follow through in the selling of silver despite breaking a triple bottom level, breaking triple bottom support. There should have been a lot of sell stops triggered. There weren't, which tells me that silver has hit a firm bottom, and once we get back above 30, I don't know if we will ever go back below it, barring the final financial crisis, which we may head below it very briefly for a few days or a few weeks until the Fed kicks off its final printing round. And as usual, this silver report is brought to you by the Dirty Man Safe. If you want to support this channel, then acquire a Dirty Man Safe for yourself with code ENDGAME10 at checkout for 10% off. And the main reason why you should own a Dirty Man Safe to put your gold and silver in it is, imagine that the dollar actually does crash, which it will. It will be a very quick process. It will take a few days, maybe a few weeks, and then the monetary medium that everyone uses will not be able to work. And so the last thing you want in that situation is that you have a lot of gold and silver, but none of it is accessible and you can't do anything in an emergency.
In today's news recap, silver price surge expected in 2025 as UBS predicts $38 target amid industrial strength. UBS anticipates silver prices climbing to $36 to $38 per ounce by 2025, driven by falling U.S. yields, robust industrial recovery, and stronger demand. Despite recent headwinds, the metal's dual role as precious and industrial could fuel its growth. According to investing.com, silver prices are expected to increase in 2025, according to UBS, which is boosted by lower real rates in the United States and higher global industrial production. This is despite the fact that the metal is struggling to match the increases spurred by the central bank in gold. Silver prices increased by more than 20% in 2024, but they have recently lost impetus as a result of increasing yields in the United States, a strong dollar, and growth concerns in global markets. With speculative short positions expanding and ETF holdings stabilizing following major outflows earlier this year, the metal is trading near its 200-day moving average. This represents a positive development for the market. In spite of these difficulties, UBS continues to retain its positive stance with a target price range of $36 to $38 per ounce for the year 2025. Although rising yields have been a disadvantage, a decrease in yields might potentially improve the desirability of silver. There is a need for a shift towards cyclical commodities, which UBS anticipates will become more prevalent as the year 2025 progresses. Dual roles of silver highlight its market potential. Despite the fact that silver's association with gold continues to be high, the fact that it also moves in tandem with industrial metals highlights the fact that it serves a dual purpose as both a precious metal and an industrial metal. Now we'll show you the best clips of the latest interview where Holter talks about his price predictions, but first, smash that subscribe button and check our pinned comment for some massive offers on NordVPN. If you're a serious stacker, this is a perfect fit for you. For less than the cost of a Financial Times paper, you can protect your online activity from prying eyes with the most reliable VPN on the market. Trust me, the only thing you'll regret is not getting it 6 months ago. Enjoy the episode.
Here we have the week-to-week movement in bank reserves. We're down to 2.9 trillion. You'll see that in the next chart. But this chart I want to show you, I've highlighted the 4-year end movements in the week average of bank reserves. The last week was January 1st, 2025, and we fell $151 billion. In 2024, it was $183 billion. In 2023, it was $187 billion. And in 2021, it was $54 billion. So we're sort of in the middle range here, where we fell 151 billion in reserves. If we see the next chart, we'll see where we are in total and relative relation to where we were during the regional banking crisis. So this is where we are in reserves now, this plummet below. This was the regional banking crisis. This big line up here is the regional bank bailout. That's why reserves shot up over here. And then you had another big renaissance, I guess, in reserves going into 2024, and they've been falling since April 2024 when the debt ceiling was raised. We first hit this $3 trillion mark back in January 2023. The regional bank crisis hit in mid-March 2023, so 2.5 months later. So if that is a repeat, if that is going to repeat itself, and there's no guarantee that it will, because I don't know exactly what's going to happen week to week, but if we're looking at similar patterns here, then we have 2.5 months until the next banking crisis is triggered. It's going to be worse than the regional banking crisis this time. It's going to be systemic. But we'll see if the Fed pulls another rabbit out of its hat. Who knows? But we're at the levels that we were in spare bank reserves that we had during the regional bank crisis. And it's going to hit, something is going to hit again. The yuan, go to China, is at final support. This is going back to 2008, actually. We have here the final support at about 735 yuan per dollar. That has hit 3 times since 2022. We break this triple top. It's really a triple bottom because the higher it goes here, the weaker the yuan is. So we'll call it triple bottom, even though it's triple top. So triple bottom, if this is broken, there's no telling where the yuan will go. China has not really experienced a financial crisis so much yet. They were pretty insulated in 2008, except for maybe what's that place, Macau, where the gambling was. They still have their huge housing bubble to deal with all these ghost towns. They have a lot of crap to deal with over there, and they haven't dealt with any of it yet. So we'll see where the yuan goes. And why is the yuan going down, down, down? Because we have rates here in China that are going down to all-time record lows at 1.6. And if you look at these monthly candles, these bars, this bar is as long as any bar that has ever existed in this market here for Chinese bonds, comparable to 2008 when they cut interest rates from about close to 5% to about 2.5%. They halved them. And now we are at all-time lows, and they're going to go to zero, just like the U.S. did, just like the Fed did. And after that, they're going to run out of room in their Keynesian toolbox. So we have here Chinese stocks are in a mega triangle. We see this has been the case since 2008. We had a huge top here at about 6,000 in the Shanghai Stock Composite Index. And this, I drew two triangles because this is not an exact science. You could draw triangles in many different ways. But generally speaking, we have the triangle pattern here. If you're going to take the black line, then it touches here in the top in 2015, and it touches here in the top that was made just before the new year in late 2024. And over here, we have the triangle moving up, the bottom's moving up. And if you want to take the red one, you can take the red one. Either way, we're very close to an apex here. And once we get to that apex, something big is going to happen. I think these stocks are going to go down if they don't print, and they're going to go up if they do print, except the value of the yuan is going to be very low, even if these stocks do go up. Chinese stocks are not a safe haven for inflation.
In today's news recap, China secretly buys a large amount of gold. Goldman Sachs, 10 times more than official reports. A month ago, Goldman Sachs precious metals analyst Lena Thomas believed that due to the continuous purchasing of gold by central banks, especially the fervent pursuit of gold by China, gold would rise to $3,000 by the end of 2025. This view from the bank was quickly challenged by skeptics who argued that with the dollar reaching historic highs, gold is unlikely to maintain its upward momentum, and a stronger dollar is one of the biggest consensus points of the Trump trade. First, Goldman economists expect that in a global monetary easing cycle, the Federal Reserve will lower interest rates while the dollar strengthens, but it will be U.S. policy rates that drive investor demand for gold, with the dollar not playing a significant additional role. In the bank's baseline assumption, a 100 basis point cut by the Federal Reserve would boost gold prices by 7% by the end of 2025. But if the Fed only cuts rates once more, gold prices are estimated to rise to $2,890 per ounce. Secondly, Thomas disagrees with the view that a stronger dollar will prevent central banks from structurally increasing their gold purchases, as central banks tend to purchase gold internationally with dollar reserves. In fact, large central bank buyers tend to increase their demand for gold when their local currencies are weak, to bolster confidence in their domestic currencies. Third, the trend of both the dollar and gold prices rising with uncertainty supports their role as a hedge in a portfolio, including hedging against tariff escalations. Finally, Goldman economists expect that broader easing policies should have a roughly neutral net impact on China's gold retail demand, as the stimulus from lower interest rates on gold demand is roughly offset by the impact of rising local gold prices. Before we dive into the best clips of the week, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights.
In my non-professional opinion, gold to S&P ratio has been stuck for 9 years in a trading range since 2016. We can be generous, say 2016, so that's 9 years. This is what is preventing most of the money from charging into gold. They see that their stocks are doing better, and they are, because this ratio has been drifting down slowly for 9 years. And as long as this ratio shifts down, stocks outperform gold. So it doesn't matter how good gold does. If stocks are doing better, there's no interest in it, which is the case now, even with gold at or near all-time highs. We are an enormous gold triangle relative to the S&P. So this is the S&P to gold to S&P ratio going back to 2000. We see here we had this all-time low. I think this was an all-time low in 2000 with gold at 250 something. And we have this triangle that was tested in 2022 with the low there. It's tested again in 2024. And we've had these highs going down since 2012. We have a very, very long, sharp triangle here. When we break out of here, this is going to go way, way up. And bubble assets, bubble stocks are going to be abandoned for real money. And that is not going to be pretty. This is the most pathetic chart ever for gold and silver miner owners like myself. And yes, it's frustrating, and I don't deny that. And I understand that you watch people with these stock portfolios, with these Netflix or Facebook or whatever stock they have, and it's all part of the bubble economy and whatever. And it's frustrating, and Bitcoin and all this other stuff, but money stocks are going to have their day of vengeance. There is a triple bottom here that has formed from 2016 to 2018 to 2024. I don't think we're going to break below it. And once this thing takes off, you'll see in a previous post, I linked it to the bottom here in the description, that once gold stocks take off, they take off hard. And I show some historical perspective and comparisons for when this is going to happen. And you can see that on the Endgame Investor on Substack, link in the description below. Check it out. No downside follow through in silver. So we have here this line, this gray line shows a triple bottom in silver at around $30. And it's been tested 3 times since September. And we would have expected that once this broke through over here in late December and we broke through 30, we would have expected a lot of sell stops being triggered and a big volume in sales here, selling volume rather, but we didn't see that. We see volume actually drop off. So I think once we regain this, that's it. We have a marginal break of a triple bottom and then a reversal that is very bullish. The selling pressure in silver appears to be over.
That wraps up our deep dive into Rafi Farber's perspective on the ongoing liquidity crisis and his unwavering bullish stance on gold. Rafi's analysis highlights the growing pressure in financial markets and the role gold plays as the ultimate safe haven during times of systemic uncertainty. As liquidity dries up and central banks are cornered into increasingly drastic measures, do you agree with Rafi's outlook? Is gold the cornerstone of financial survival in the face of a liquidity crunch, or do you see other assets playing a bigger role? Let us know your thoughts in the comments below.